This video is about short selling, why it is dangerous, reasons that people do it anyway, and what makes a good short. Shorting a stock is basically just betting that it goes down, as opposed to going long a stock, which is where you bet a stock will go up by buying shares. The simplest reason that short selling is risky is because your downside is unlimited and your upside is limited. So we'll just quickly walk through an example here. Let's say that you shorted Regeneron Pharmaceuticals back in the 90s. You would have a return of negative 4,000 or so. And if you sold $1,000 of Regeneron short back around here, essentially betting that Regeneron stock would go down, the most you could make if it went to zero was the $1,000. You shorted $1,000, the most you could make is 100% profit of $1,000. But the most you could lose is essentially everything, like hundreds of thousands of dollars. That's not a great risk-reward trade-off. And that's the main issue with short selling. The risk-reward compared to going long a stock is just much worse when you're short. So when you short a stock, your upside is capped at the amount that you shorted, but your downside is unlimited. Whereas if you go long, your upside is theoretically unlimited, whereas the most you can lose is the amount that you put into the stock in the first place. So that's why in short selling is more risky. So why would anyone short a company? Well, in biotech, it's often because you think a clinical trial will fail, for example. So taking the case of Tibera Pharmaceuticals, if you thought that they would fail this phase 2 study, so they did a phase 2 study and then it dropped by more than half after the study failed, and if you predicted that study failure correctly, you would make a 50% profit overnight, which is pretty good. And if you're confident that a study will fail and the market thinks the study will succeed, it can be tempting to short the stock. And in some cases, if the market is actually pricing in near 100% success, you can actually get a pretty good odds-on bet that the study fails and that you make money if you short. But that's still a risky game. So imagine that after you get this phase 2B short call right, so say you short the stock, goes down, and then you hold on to the short position. It's still trading at $4 a share. You think it could go down, to $1 a share, and you can make even more money. And then you wake up one morning and you see this. The company is acquired by Allergan for $40 a share. And what looked like a home run short turns into a negative 250% loss. And that's not uncommon in a volatile industry like biotech. Be very careful if you do decide to short. But before we go more into when short selling could actually make sense, we need to talk about how it works. So how do you go short a stock? If you go long a stock, you just buy the shares. It's easy. Everyone's done it. But when you short a stock, how do you sell shares that you don't have? Well, the answer is that you borrow them. So a short seller wants to borrow shares, but they don't have them. So they will borrow shares from a lender. And then in return for lending out the shares, the stock lender will get some interest. Now, in reality, the stock lender is usually a broker. So if you are, a customer of some sort of brokerage firm that you have an investment account with, usually when you sign up for an account with them, they will make you sign an agreement that says that they can, lend out shares at their discretion. So someone's broker is going to take stock from their account and they will lend them to you as a short seller, and then they'll make a little bit of money for doing that. And then the short seller takes those shares that they borrowed and they can just sell those shares in the open market, and then you get cash for that. So if you're a short seller, just to recap, you think a stock price is going to go down, you borrow some shares from your broker, and then you can just sell those shares and you make money, but you have the obligation to return those shares at some point. And because you just sold those shares, you're going to need to buy the shares in order to close out the trade and complete the terms of your loan. So to close the trade, a short seller will buy stock back on the open market and then return it to the lender, ideally for a lower price if the short seller gets his or her way. So to close out a short trade, the short seller buys shares back on the open market and delivers them to broker. So the two legs of the trade, short seller borrows shares, sells them on the open market. Hopefully the price goes down, and then the short seller can close out the trade by buying the shares for less than they paid for them, and then they make a profit. Let's say in this case, it works out for the short seller. They sell short at $10 a share. The stock goes on to $5 a share, and then the short seller buys the shares back at $5 a share, which gives them a $5 per share profit. But if the stock goes up, that could make the broker, unable to essentially get back the shares that they lent out. If the stock goes up too high, the short seller can't afford to buy them back, and then the broker loses out. Brokers will not lend shares if there's a risk that they're going to lose the shares that they lent out. So the broker requires the short seller to put up margin, basically collateral for borrowed shares. It can be cash or securities, just some assets that the broker can hold to cover the short seller's liability. So let's say the short seller borrows $100 worth of stock, and then the broker requires $150 of margin. So the short seller has to have $150 in some sort of asset value in their account in order for the broker to lend them $100 of stock. And then if the value of the stock goes up, so the short seller, that's bad if the value of the stock goes up, the broker will issue a margin call, basically telling the short seller that they need to put up more margin or collateral, or they need to close the position. Because again, they only took $150 of margin. If the stock goes up to $120 a share, the broker needs some more cushion, so the short seller has to put up some more margin in order to maintain that position. If the short seller can't do that, then the broker can liquidate other assets in the account to meet the margin requirements. Here's another thing that's important to know about shorting a stock, especially for biotech, this concept of hard to borrow. So if you remember, I said that when you borrow shares to short, there's some sort of cost that you pay, just like when you take out a loan to buy a car or a house, you have to pay some interest. So when you're shorting a big company stock, it's usually pretty easy to borrow the shares and the cost of borrowing it isn't too big. But for a lot of small biotech companies, there really aren't that many shares out there that are available to borrow. Like a lot of the shares are held by management or venture capital funds. There's just not a lot of shares out there. So in some cases, you just can't short the stock. In other cases, you can, but you have to pay a higher interest rate on borrowed stock. Sometimes 3, 4, 5% or so. And if you're holding that stock for a long period of time and you're paying like 5% interest, the cost to carry that position is eating into your return. So that's another reason why shorting stocks is bad and is risky, is because it can cost you money to hold those positions, and that borrow cost can eat into your returns. So that's what shorting is. We discussed why it's risky. There's unlimited downside but limited upside, whereas if you go long, the upside is theoretically unlimited, the downside is limited to the amount you invested. So the risk reward for shorting can be rough. So why do people short stocks in the first place if it's so risky? So you can do it, obviously, like we said earlier, because you think a clinical trial is going to fail, or you think a drug launch is going to go worse than expected. Basically, you can do it for the same reason you'd buy a stock. You think the market will move in a certain way and you want to place a bet. But the odds are not as good, as we said, if you go short than if you go long. So making sort of a regular investment strategy around shorting is kind of iffy. But there's another more logical reason to short, and that is hedging. So hedging is basically a term for reducing the risk of an investment, like hedging your bets. And it's actually where the term hedge fund comes from. So back in the day, most investors just bought stock, but hedge funds had this clever idea of hedging their positions from losses by doing other trades to offset the risk, like shorting stock. So why would you hedge? It may sound obvious, but we'll just walk through it here. So essentially, let's think you have a lot of stocks. You're worried about a recession. One way that you could manage that risk of stocks going down in a recession is to hedge. So you could hedge your recession risk by shorting the stocks of companies that will do poorly in a recession. So maybe, you think that like a luxury brand like Louis Vuitton would do poorly in a recession. So you could short that stock in order to protect yourself a little bit from the downside of a recession, right? If there's a recession, Louis Vuitton stock goes down and you're short Louis Vuitton stock, then you'll make a profit and that could offset your losses. So if you hedge your portfolio, on the left side here is that unhedged portfolio. And if times are good, so if times are good, if you don't have a hedged portfolio, you will do very well. You're just 100% exposed to the upside of the market. But if you hedge your portfolio and the market goes up, then you won't do as well as an unhedged portfolio because you have some short stock, some long stock. You're just going to have a little bit more muted return. But a hedged portfolio will outperform in bad times. So if you only are long stock and there's a recession and stocks go down, your portfolio is going to tank. But if you have a balanced hedge portfolio, your portfolio may not go down if the market goes down. You may have some short positions that will cancel out the negative effect on your long exposure in your portfolio. And you may not want to do some sort of complex hedging exercise in your own portfolio, but if you're interviewing for jobs at biotech hedge funds, you will often be asked to pitch a short if you interview. So usually you prepare a long pitch where you think, where you say why you like a stock and you recommend a stock to invest. A lot of times these funds will also ask you to recommend a short fund. And that's because a lot of these are what you call long short funds. So a long short fund is a hedge fund or other fund that takes both long and short positions. And they do this as a way to hedge. So long short funds theoretically hedge away some market risk. So they'll have less volatility and also potentially lower returns, although you can make up for that in other ways we'll talk about later. So a long only fund, and here's the y-axis is return. So this is positive return, this is negative return. A long only fund is going to be more volatile. If the market goes up, the long only fund will do well. If the market goes down, the long only fund will do poorly. Whereas if you have a long short fund, then when the market goes up, part of your portfolio, the long part will do well, part of your portfolio will do poorly, the short part. So you'll have a more balanced hedged portfolio. But you'll also have lower returns because your longs offset your shorts. So a long short fund reduces the return that you get from market risk. So that's also known as beta. And to get positive returns with a long short fund, you rely not on exposure to the market, but you rely on your ability to pick stocks. So this is also known as alpha. And if you are accurately able to pick the best stocks that you go long and the worst stocks that you short, then you could get theoretically a high return in any market, whether it's up or down, with very low risk. So if you go long the best stocks, when the market goes up, your longs are going to go up more than the market does, so you'll have excess return. And that can offset the short positions, because when the market goes up, short positions go down in value. On the other hand, if the market goes down and you short the worst stocks, then your shorts are going to go down more than the market does. So you're going to have some excess return there. And then if you are long the best stocks, theoretically, those won't go down as much as the market. So you just basically theoretically get excess return over the market because you're better at picking stocks. And because you are long short as a long short fund, you are insulated from market risk. So that's sort of the best of both worlds, right? You get lots of return for very little risk. So this is just a sort of quick theoretical example here. So these are a long short fund with high alpha, where you're good at picking stocks, and a long short fund with low alpha, where you're bad at picking stocks. And again, the volatility for these funds is going to be lower than just a long only fund, but the return will also be lower as well. But the catch is, if you can actually get high alpha, you will have positive returns in any market. On the other hand, if you're not a good stock picker, you will never beat the market. And that's actually what happens with most hedge funds. But this is an incredibly attractive proposition for investors, because if you as a hedge fund can promise your investor clients that you will always get some sort of positive return, even if it's small, you have a better risk reward ratio. And if an investor wants to increase this return, they can just take on leverage to juice returns, and they can take on more leverage because they have lower risk. So this is a very sort of attractive theoretical concept. It doesn't always work so well in practice. A good case study of this going wrong is long-term capital management, which crashed back in the late 90s, and is a good thing to look at if you're trying to learn about portfolio theory and hedge funds in different ways, so you can sort of modify risk reward in a portfolio. All right, so to wrap up here, we'll just quickly walk through what makes a good short. Again, I don't recommend that you short stuff in your personal portfolio unless you're very experienced, you know the risk, you know what you're doing. Even then, be careful. But if you're working at a hedge fund, you'll probably have to do some short pitches. So what makes a good short? The most important thing is you never short based on value alone. There's this famous saying that the market can be irrational longer than you can be liquid. And a stock can stay overvalued for a very long time. And in fact, it can get even more overvalued. So if you short a stock just based on value, that's probably the best way in almost all of investing to lose money. So don't short a stock based on value. Short a stock when there's a clear catalyst, when something can happen that forces the stock to come back down to reality. So the catalyst is often in biotech like a clinical trial. You also want the catalyst to have a clear and short-term time frame. So if you short a stock, but the catalyst is like 3 years from now, why would you be in that short position now? Again, when you short stock, there's a cost to carrying that position in terms of the cost of borrow and margin and things like that. So you just want to make sure that when you do short a stock, you have a clear time frame. Also, when you short a stock, you pretty much always have to pay long-term capital or short-term capital gains on it. Whereas if you go long a stock and hold the position for over a year, you pay long-term capital gains, which is a much lower tax rate. So you don't really get extra tax credit when you have a short for a longer period of time. So you want to have a catalyst with a clear and short-term time frame. And you also need the risk reward, obviously, to be biased to the downside. So the stock needs to be overvalued, but that's a necessary but not sufficient condition. You need overvalued and a clear catalyst. And then you also need a clear plan to manage the position. So you need to know how much it's going to cost you to hold this position, what the margin requirements are, and then you need to know when to get out. If the market moves against you, you need to know at what level you will exit the position and at what level you will hold the position with conviction. Because in a volatile industry like biotech, especially with small caps, things can get away from you pretty quickly if you're not careful. So more specific to biotech, oftentimes betting a clinical trial will fail is a good short opportunity. It can also be a terrible, terrible short opportunity because if you don't understand the risk reward of the investment, and if success is not priced in, you can get crushed by shorting clinical trials. Because again, if a clinical trial fails, the most the stock will go down is 100%. Usually it's more like 50, 60, 70%. But if a clinical trial succeeds, a stock can double, triple, quadruple in value. And if you're on the short side of that trade, you can get absolutely obliterated if you take a short position and the risk reward is not in your favor. So again, don't try this at home. If you do work at a fund and you pitch short ideas, your portfolio manager can tell you when you're being an idiot and help you to adjust your positions. But this is really risky, but just wanted to make it clear that if you are pitching a short for a hedge fund, a clinical trial could be a good catalyst. You can also do things like shorting a drug launch or shorting a quarterly earnings release. If you think a drug that's recently launched is super hyped up, but you don't think it's going to meet sales expectations. And you can often do some market research to develop these theses and validate your views on this. So, for example, if you're looking at like a rare disease drug launch and, it's really hyped, the stock went up when it got FDA approved and when it got good clinical data. But maybe there's like 50 physicians in the whole country that treat this super rare disease. Sometimes you can go and talk to like half of all those doctors and ask them how many patients they've treated in a quarter. And that can give you a really good sense of what the revenue is going to look like. And if it's going to be lower than expected, then you can short based on that. Because again, quarterly earnings are a near term and a clear catalyst. And if you have confidence that the sales revenue, the sales of the drug is going to be a big stock mover around the time of the quarterly earnings, and you have a view that the stock will, or the revenue will underperform expectations, that can also be a good time for a short. So that's it for this talk here. Short selling is something that a lot of investors like to explore when they first start getting into biotech, but it's super risky. So I just wanted to make this video to let people know what to watch out for. And also to understand that it is a skill you can develop if you get to work at a hedge fund or interview at a hedge fund. But be careful when you short stocks, even in a bear market like this, because it can be painful if you get it wrong.